Both forecasts are down by 0.1 percentage points from those given in October. Joining me now to discuss this further is Jose Vinals, Financial Counsellor for the IMF. Thank you so much for joining us today
You're
on
welcome.
Power Lunch. Fantastic. I mean, just looking at the most recent UK GDP number for the fourth quarter, we saw what people call a shock contraction, down 0.5%. A very different scenario that is playing out for the likes of emerging markets. And just given the new report that has been released, prospects for South Africa is still pretty much intact, down marginally, as I mentioned, 0.1 percentage points for 2011. Yes,
I think that there is a difference between what we're saying in a number of advanced countries and emerging markets. The basic line that we take is that the world economic recovery is going to continue. This is the good news, but it's going to be a bit more moderate. And I think that the challenge is that in advanced countries, what you have to do is try to increase the growth rate so that it's closer to potential. And in the emerging markets, you have to make sure that the growth can be sustained so that some of the economies which may be already reaching growth rates which are close to capacity can undertake the policies so that this remains there. For South Africa, it's a little bit different in the sense that it looks more like an advanced economy in the sense that the growth rate is quite below potential, and this is an issue going forward.
And what could we do to spur economic growth further? I mean, unemployment has been one of those massive hindrances. I mean, of course, policy changes and productivity issues as well have always been those things that have come up time and time again.
Yeah, I think that in the context of South Africa, you have a very high unemployment rate. And I think that it is very important, in addition to economic policies that keep sustaining the recovery of demand in a non-inflationary context, that you do also policies that improve the competitiveness of the economy by enhancing the productivity of labor, by keeping labor costs moderate. And this is something that many other economies have found fundamental in order to improve competitiveness, keep costs down and productivity up.
Okay, well, that's quite an interesting view as well. I mean, looking at the local currency, and I'm sure it's been also interesting to see most emerging market economies trying to ensure that their currencies do not appreciate by intervention. We know the South African Reserve Bank has also said that it is going to be accumulating reserves to try and weaken its currency. Do you think that that is also a way to keep South Africa more competitive, or do you think we could use other tools, as you just alluded to?
Well, I think that competitiveness is something that needs an ample front of policies in order to improve it, because it's quite difficult. And I think that avoiding an excessive valuation of the currency is important. Avoiding overvaluation of the currency is important. So from that viewpoint, the interventions in the foreign exchange market are understandable. But I think that at the end, what is fundamental is not just the evolution of the nominal exchange rate, but also of the domestic costs and prices. And this is what brings me to the need to upgrade, through structural reforms, the status of labor markets and the status of product markets so that the economy can become more competitive also over the medium term.
Do you think that is possible in the South African context, given the fact that unions are very vocal about wage increases, and we've seen it happening this year? I mean, above inflation wage increases is what South Africa is usually dealing with on a year-to-year basis.
Well, I can tell you about the experience in other countries. And this is that if you really want to have an economy that can grow and that can create employment, you may have to take some hard decisions in the short term, but over the medium term, it pays off in terms of jobs and in terms of growth.
Taking a look at peripheral Europe, and I'm sure this is a question that's been posed to you time and time again, and the risks that the global economy face because of this. I mean, we know that South Africa's growth rates are very similar to what we see in the developed market, as you alluded to, but sub-Saharan Africa and the rest of Africa doing very well. Are we starting to see a massive divergence between what we're seeing in Africa and Europe, and perhaps we're not as affected by the peripheral European issues as we thought we were?
Well, I think that it is very important that Europe solves its problems, because otherwise this is something that would be no good for the continent. In particular, in the case of South Africa, let's remember that Europe is a major trading partner. So through commercial linkages, it is very important that Europe keeps growing in order to sustain imports from South Africa, exports from South Africa to Europe. But I think it's also important that the European problems are solved in order not to create another bout of lack of confidence in international financial markets that would be something negative for all economies and more for those like South Africa, which are more integrated in international financial markets. So I think that if Europe does better, I think that it would be good for the whole continent, and particularly for those economies which are more open, both commercially and financially, and which have stronger ties with Europe.
Reserve Bank of India, the most recent central bank to hike rates. Last week we saw Turkey cutting rates. We've been seeing most emerging markets hiking rates. It's been quite interesting to see the different views of all the central banks. How do you see this playing out on a global level, and do you think this is going to be a big risk? And of course the inflation story then feeds into this argument as well.
Yeah, I think that different countries are in different situations, so there is no one-size-fits-all recipe. And you have some countries which find it convenient because of their inflationary situation and the capital inflows that they have to reduce interest rates in order to get a more balanced economy. And there are other countries which are having already economies which are growing very fast, where inflation is on the verge of going up too much, and where they're having also capital inflows. And then the problem is that if you increase interest rates, you may attract more capital inflows. So you have to really have a more diversified set of measures in order to deal with the problem. So I think that inflation may be a concern in a number of countries. In those economies which are willing to let the exchange rate appreciate because they don't have competitiveness problems, the best thing would be to raise interest rates. In other countries where inflation may be an issue, maybe you need some more widespread battery of policies, including not only monetary but also fiscal policies, in order to take some of the pressure from monetary policy.
Mr. Vinals, just to end off, what do you think the biggest risk is to the global economic recovery?
I think there are a number of risks to the global economic recovery. Of course, if commodity prices were to skyrocket, that would certainly be a risk. I think there is also a risk if in Europe the problems were not to be solved definitely, and there would be also a risk of maintaining the present situation of global imbalances, because that is something which is not contributing to the necessary rebalancing of growth from emerging markets towards advanced countries. So I think that these are three key risks for the global economic recovery moving forward.